Hello and welcome to Can You Believe It? Episode 5, My How Time Flies, of Angel Insights, brought to you by SyndicateRoom. And on today's show, I'm so thrilled to welcome Alex Dunsdon. Alex is Investment Director at SaatchInvest, a seed-stage VC firm in London that have investments in the likes of CityMapper, Comparabien, Technology Will Save Us, Ometria. And what's so special about SaatchInvest is, as they say on their angel list profile, they really do act like angels and differentiate themselves from traditional VC firms. If that wasn't enough, Alex is also a founder at The Bakery, an ad tech accelerator that helps big brands with their integration of new technologies into marketing campaigns. And on today's show, we delve into Alex's approach to due diligence, sector knowledge, his favourite angel investing resources, and much more. Here is just a sneak peek of today's amazing episode with Alex.
Certainly the reality of early stage investing is you don't have those numbers.
Ladies and gentlemen, without further ado, it's time to welcome Alex Dunsdon. Alex, welcome to Angel Insights. It's an absolute pleasure to have you on the show.
Thank you for having me.
Can you start us off by giving us a little background about you and how you started off and made your way into the investing world?
So, I don't know if my story's typical or not, but my story very simply goes, I used to work for a company called Saatchi for a number of years. I spent a lot of time hustling about, and part of that hustle, we did a deal to buy a mobile company, which turned out wonderfully well for Saatchi. And from that, they got the idea that I might be okay at finding tech companies to invest in. So Saatchi, basically I was hustling them to do a fund. I left there. Then they phoned me a couple of months later and said, let's do a fund. And I was like, that's a good idea. So we started. So we tend to invest about between 100 and 300,000 in very early stage tech companies, and we've been doing it for 2 and a bit years now, and it's just an extension of what the organization's kind of done in the service world, right? So they back founders in the service world, get them start PR businesses, direct businesses. That's their basic model, and we've just translated that into essentially backing people, backing founders at its very heart in high growth tech businesses, and it's great fun.
And what do you then look for in founders? What do you really gets you excited when you see founders?
So I call them, there's a bit of I think a lot of this game is pattern recognition, okay? And the pattern that we probably most like is, I'd call them sort of humble learning machines who have a ridiculous amount of tenacity, right? So if you find people who are just want to learn all the time, have this crazy willpower to run through walls, and if it's really, really hard, you just know that they'll have the determination to do it. But they've kind of got this, that they can make up their minds, they've got good instincts, but they're humble, right? They're not really super arrogant. Of course, these guys can make huge businesses. There's a lot of, very... maybe not so nice people who make very good businesses, but we tend to back people who we really like to work with. And yeah, that's how I think of them. Just they've got the humility to learn, to ask questions. And the thing that we find is the people who seek the most advice, but have a very firm view of what advice to listen to and what to go for, tend to be the kind of founders that we really love.
And you said there about building a big business. A big business has to be built in a big market. How big a market is big enough for you as an investor?
Well, we're different, I guess. So, look at us versus, say, a VC fund, right? So a VC fund would go, I will back any company that has a 10% chance of being a $1 billion company. You spread it, and the power law distribution of VC says 1 or 2 you hope will really make it huge. And that's how you play the game. For us, we go in really early. We do obviously want those, and we back big, exciting ideas in huge markets. And we can go into some examples if we want. But equally, we don't need them to do that. So I think, when we work with these companies, we it's sort of, if we get in really early, if we get, 10% early, and we follow on so we don't get diluted. Anything between a 10 and 40 million quid exit can still be good for us.
Absolutely.
Obviously we're looking for the big one, and we do back big, exciting founders. But, I think Nick Brisbane wrote a really good post on his blog a bit ago that goes, the economics of VC can sometimes be crazy. Not everybody needs to back $1 billion business. And I guess you can put us in that category.
And on the Saatchi angel list page, you say you act like an angel. How does that really differentiate from acting like a VC?
Speed, number one. Probably the main thing, to be honest. So the guys, I love working with the guys. So basically we work with the founders of M&C Saatchi. They are essentially like angel investors in that they've got really good instincts for founders. And we just go, they come in, we have a 20-minute chat, no more. We either really rate them and like them or not, and we think the idea is really exciting or not. And it might sound glib, but there's a very much an emotional excitement that kind of very much drives the early decision. The second thing we do is we get them in front of the guys really early. So rather than have 10 meetings and then you get to the big partner meeting, we just go, look, there's something here. Let's take a really quick check, see if we're excited. And then, of course, Leo and I run the fund with a guy called Leo Castellanos. We then obviously do diligence to make sure, but we try and give quick term sheets. We find that's a competitive advantage in the market. And we try to move quickly. And I think we tend to back ideas as much as anything. Like, we like things that solve big human problems. So things like, technology save us is one of our companies. Technology will save us. And their big notion of the world is that we need to teach the kids the code of the 21st century. CityMappers, all about how do you make cities usable. We love big ideas that solve big human problems.
And then what do you think, if you act like an angel, are there any things that angels should be doing that VCs don't do, and vice versa?
What do you mean, anything they should be doing in terms of helping the companies, working with the companies?
Yeah, should angels be providing, business and emotional support as well as access to further funding rounds, which maybe VCs won't provide such intense levels of support?
Yeah, I mean, look, it depends on each individual investor. I was actually speaking to Maria at Angel Labs, who are a good bunch, and I find their approach quite interesting. They take quite a professional approach to angel investing. So I think there are a bunch of things that we have seen companies where there have been angels who have maybe been very well intentioned but not necessarily given the best advice to tech companies, and they've done things like expand too quickly, spend money in the wrong places, and perhaps sometimes that support is misguided, but I don't think there's a rule of what angels should and shouldn't do. I think it's up to each entrepreneur to work out what they need at a certain stage. If they're just like, look, I'm fine, I just need some cash, leave me to it, and everyone knows that might be fine. If they're like, look, I really need your help getting to market, then you have those conversations early and work out. I think the key thing is just working out right up front what everyone's expectation is. Like, we're having conversations with companies where we have it a lot of time where we go, are you sure you want to take VC money? Are you sure you want to go on this path? Like, there's a ton of companies out there that just shouldn't take VC money because, then you got investors on your back, you've got to hit high growth targets, you've got to get to the next round of funding. And it may well be that the market just isn't there for that kind of product. So I'm going slightly off the point, but there's quite an often time where the kind of advice you get at early stage is really, really important. Like, we speak to a lot of companies and say, are you sure? It'd be quite good to get a 10, 20, 30 million quid exit for you. Keep all your equity, don't give it all away, and, have a great business. I think there's a thing at the moment where everyone sort of assumes they have to take... I spoke to a founder the other day, he said, I just never thought there was anything but tech investor money out there. And I'm like, tech investor money is the minority in the world. So anyway... I don't know if that answered your question or not, but I think a lot of it is about getting the right expectations set up front.
And you mentioned that you and Leo then indulge in a bit of DD. What does that entail, and what do you really dive
It depends. It depends. If it's a founder with a piece of paper, it's maybe speaking to people who've worked with them before. It's like spending a lot of time with them and understanding how they work. I find the best thing to do, and probably don't do it enough, but I do try to do it, is just to spend time working with the team. Like when we invested in Dojo, for example, it was actually only an afternoon, but it was just really, really great just to understand how they worked. So it does depend on stage of market. If it's bloke with a piece of paper, you can't do a ton of DD. You can look at the market size, you can look at the founder, you can check maybe people with more domain expertise if they share your view that it's an exciting area. We do go later, so obviously, when we go for a later seed round before Series A, you're looking at a lot more, because then you've got numbers to look at, right? So you can start looking at, depending on what the business is, what is their cost per acquisition? Are their numbers going to work? How's the team? How's it all gelling together? Is there any co-founder risk? What are clients saying if it's a bit of enterprise software? It depends on each business. It's the cap table, right? So, a lot of this game is understanding what people will invest in at the next stage, and sometimes founders have diluted themselves ridiculously, and you have to recapitalize the cap table. Like, this is all stuff that you learn along the way, because I think so much about early stage investing is kind of understanding the game you're in, understanding what future VCs will want. If you're on that high growth tech track, like, if you're a SaaS business, they'll have certain metrics you have to hit, and so you just need to be optimizing against those.
So do you, as an early stage investor, help your portfolio companies to kind of model themselves to the VC desires?
I think one of the things I always say, so we're on some early stage boards, and it's just quite boring, and I'm like, just find out what the VCs want, speak to them all now, speak early, full-time, fundraising's a full-time job, like, know the game, know the parameters of the game, find out what they want. Find out what you need to achieve, find out what the right KPIs are, and then execute against those. Because if you don't know the game, you're sort of flailing around and just doing stuff. And all VCs won't agree, right? It's not an exact science, so it's not like find out exactly what they say and hit that exact thing. You've got to leave room for them to grow the right culture and do some things that they think, if they really believe in it, they need to do. But fundamentally, you do need to understand what they want and what they will invest in, because so much of what VCs do is based on models and forecasts and risk profiles and formulas. And if you're just outside that, no matter how good you are, it's going to feel too risky for them.
And investing at the early stage that you do you often invest alongside angels and seed funds?
We have done. So we've been in with people like Playfair, we've been in with people like Connect, we've been in with couple of, I guess, super angels a few times. You do get those kind of relationships, and you do naturally form relationships with people you like to go in deals together with. So we definitely do like to do that. I think that kind of thing's increasing. I think you're seeing more money going in an earlier stage, which can be a good thing, can be a bad thing. But I think you're going to be seeing more co-investors, bigger rounds earlier. So I think that's just a trend that will continue. And also as the ecosystem develops, right, if you look at the States, I think people like First Round Capital go in a lot with, I don't know exactly who, but there's I think Spark Capital going a lot with Union Square Ventures. And I think what you do is you just tend to get relations over time, and if you find a good deal, you like each other, you go for similar things, you just say, hey, do you fancy this one? A lot of it is about relationships.
And what do you then look for in your co-investors? Do you look for sector knowledge, money? What really is important for you?
I think over and above all, relationship, knowing each other, knowing you'll be comfortable going in together, especially if, for example, you're both on a board, and if they do have an early stage board, to make sure you're aligned. And then it depends, right? You might go, well, it'd be really great to get that domain expertise on the board. These guys are in retail, so to have someone who's lived, breathed, operated in retail, it's really reassuring to have on the board, or in as another investor. But it does depend. It depends on a range of circumstances. But broadly, domain expertise, good relationship, and just being good, right? Just knowing the game, knowing what VCs will want, being supportive in future rounds of funding, all that good stuff.
And do you personally like to have sector knowledge before making the investment?
Increasingly, probably yes. I think that I think it helps to de-risk it. So when you say sector knowledge, so I've worked a lot in with a lot of brands. Partly with I do another role, which is I run a company called the Bakery London, and so we tend to know a lot about the big problems in companies, whether it be Panasonic or BMW or Eurostar or RBS or AB InBev or a ton of different companies.
Absolutely.
And so I tend to get first-hand, and I used to work in that industry, insurance as well we work a lot in. So you tend to really understand a lot of those problems. And if anything, we don't have a sector focus specifically. But if anything, I'm probably biasing slightly more towards enterprise and the latest deals. I think research is a particularly interesting industry in terms of the amount of money spent versus the amount of innovation that's happened. I'm very interested in that area at the moment. But, we fundamentally back founders, right? So if we find founders who are freaking great at product and we fall in love with, we'll do it.
And I'd love to dive into a quick fire round now with you.
Yeah, sure.
So the best angel investing resource?
Other people.
Okay.
So relationships with other founders. So if you're then talking about how do you find deals or how do you then do comps, I mean, there's so much that's kind of available on Google, right? So you can look at Crunchbase, look at comps for other investments. You can look at AngelList for deal flow. But fundamentally, I still think this is, there's a lot of talk about automating VC processes, but I think fundamentally it's a relationship human game.
And then what's the hardest aspect of angel investing or seed stage investing?
Dealing with either failure or the thought of failure, right? So nobody's ever going to hit 10 out of 10 investments. So I think the general rule would be, out of every 10 investments, even the best VC funds get 1 to 2 home runs. They get 3 failures and 3 or 4 who just about make them a bit of money or more money back. And I was speaking to... and it is the hardest thing, right? Because I was speaking to Doug Scott about this the other day. It's a very counterintuitive thing, angel investors, because sometimes you have to look at companies who may or may not make it, and you might have some that fail. And actually your ability to deal with that and to be able to take that risk in the knowledge stroke hope that the companies who really make it really big, that's kind of the game. But it's very counterintuitive as a human. There's a blog post by a guy called Chris Dixon in the States who works for Andreessen Horowitz.
Absolutely, yeah, Chris is amazing. Yeah,
he talked about, the VCs who make the biggest wins also make the biggest losses. So it's being comfortable with that, really.
How do you deal with that, then?
I think you accept it. So look, so what do you do? So if companies aren't really... So, there's a ton of companies out there, right, who have goals where they go, in 9 months or in 1 year, I'm going to hit enough for a Series A. And then they come back and they never had quite enough money, especially in the UK, or they didn't quite smash it enough, so they go for more money. And there's always that question about, well, do you follow and does outside investment come in? And it's sometimes quite hard to know, because sometimes... these are new things and they're new ideas and they're new markets, and you just have to get comfortable with it. You just have to psychologically go, this is part of what we do.
Yeah.
Because it's high risk, right? It's nuts, right? What we do, we invest in people with a bit of paper. They got some kind of idea, and it's so hard to build a business. Like, anyone who says it's easy, it's freaking crazy. The people who are doing it, any entrepreneur is somehow wired slightly differently, slightly crazy, which makes it wonderful. But, it is a crazy high-risk game.
Absolutely. Absolutely. And then your favourite book and why?
My favourite book in the world?
Yeah.
What's my favourite book in the world? I don't know.
Or blog?
I think I read the same blogs everyone else does, right? So I read Fred Wilson, I read Nick Brisbane's, I read Benedict Evans, I read a bunch of people in the world that I follow, and it's just interesting. It's just you listen to all the advice, the guidance, the trends, the tips, and you work out what to take out. So I don't think I've got any particular secret little, oh, everybody should read this. I think I probably read what most other people tend to do.
And then the most recent investment you've made and why you said yes.
So we made, so actually the most recent one, we've got, it's like buses actually, we've got a few queued up at the moment. They sort of all hit at once. Our most recent one's Dojo.
Okay.
And the reason we made Dojo, they came to us and they had this really undifferentiated idea about what to do when you go out for young people. And it would have been so easy to say no. And the reason we said yes was, so what's our thesis, right? The one thing I didn't say at the start was hustle. They had hustle, right? They were handing out flyers outside tube stations, and we are absolute suckers for people who just have that extra crazy hustle in them. Second, they had that humble learning machine thing, right? Which is they listen, and then they execute. And the third thing was, the third reason was when sat with them for an afternoon, there was just an operational excellence. There was just a real rigor, a real hunger, and a real just get shit done ability. And the product was great. So it's actually a very good, everything in our sort of, the things that we like sort of came together in that one.
Well, Alex, thank you so much for coming on the show, and I wish you and Dojo all the best of luck. It's been an absolute pleasure.
Thank you very much, Harry.
As always, all the incredible resources and tips mentioned in today's show can be found on Syndicate Room's website at www.syndicateroom.com, and I would strongly advise you head on over to the article written on today's episode, which advises angel investors on how to really mould their portfolio companies to engage with the VC funding round. As always, it's been an absolute pleasure, and we would love to hear what you think of the show, so please do tweet us at Syndicate Room, or leave any feedback on iTunes by typing Syndicate Room into the search bar. We would love to hear your thoughts. Thank you so much, and we look forward to seeing you in the next episode.